silver, I think silver is getting ready to explode. We did get as high as 39 and a half, I think, while I was on vacation. It's going to make a beeline for 50. And there may be, and there probably will be rather, a little resistance around 50 because that's a massive double top going back to 1980 and 2011. But once we take that out, I think it's going to explode higher. And I think we'll be headed towards $100 an ounce is silver. Of course, gold's going to be 4,000 by then, but that still means you get a better bang for your buck in silver.
Softly default on the dollar by revaluing gold. It is one of our only options left. And for those of us who look past even being able to market, guys like James Rickards, who's saying way much higher, maybe 24,000 based upon a metric he has, or Mike Maloney, who says 10,000. 10,000 would give the Treasury General account $2.5 trillion free and clear.
Simply because the market is anticipating rate cuts that just can't happen, and you get a sell-off.
In today's news recap, gold prices higher as U.S. price data dims hopes of big Fed cut. Gold prices edged higher on Friday, buoyed by a weaker dollar, but were poised for a weekly decline after hotter than expected U.S. producer price data dampened prospects for a supersized September rate cut by the Federal Reserve. Spot gold rose to $3,340 per ounce. U.S. gold futures for December delivery edged up 0.1% higher. The U.S. dollar index fell 0.4%, making gold less expensive for other currency holders. In the short term, gold has a heightened inverse relationship to moves in the U.S. dollar, which in turn is being whipsawed by economic data and fast news on both tariffs and Ukraine. Independent analyst Ross Norman said, U.S. producer prices increased by the most in 3 years in July amid a surge in the costs of goods and services, data showed on Thursday, signaling inflation pressures in the pipeline. Weekly jobless claims also came in lower than expected at 224,000 compared to forecasts of 228,000. The data dampened bets, fanned by benign consumer price data and comments from U.S. Treasury Secretary Bessent earlier this week that the Fed's next cut might be more than a quarter point. Non-yielding gold typically performs well in low interest rate environments. U.S. consumer price data showed only a marginal increase in July, briefly boosting hopes for a large size rate cut by the Fed. We have seen in the past that gold price corrections get smaller and smaller, suggesting that some buyers who missed out in the past use these price setbacks as a way to gain exposure to the yellow metal, said UBS commodity analyst Giovanni Stonovo. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. And go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
Pretty quiet week for the precious metals. Gold itself was actually down about 0.5%. I think it settled at around 3,336. Silver went the other direction. It actually rose a tad, up about 1/3%, and we closed the week above $38 an ounce. But from a technical perspective, I think the markets are set up for another explosive rally. And what really makes me optimistic now is the action that I am witnessing in the mining stocks. Because one of the problems with this rally for many, many years has been the failure of the mining stocks to confirm the continuous breakouts to new highs in gold and silver. And a lot of people who might have got into the market were discouraged by the lack of confirmation from the gold stocks because people think that gold stock investors, are sophisticated and forward-looking. Because when you're buying stock in a gold company, you're buying into an earnings stream. And so what's more important than the price of gold today is the price of gold tomorrow or, years from tomorrow. Because investors are looking into the future and they're discounting all that income into the present. And the problem was, as investors, particularly on Wall Street, watched the gold market rise, they really didn't understand why it was going up. And they just expected that, well, it's going to go down, that this is just a short-term thing. They found all sorts of reasons to attribute as to why the price of gold was going up. And so they just assumed that it was going to go down. And so they didn't want to buy gold stocks, because if you think the price of gold is going to go down in the future, well, that means the mining company profits are going to go down, especially with costs going up. It gets more expensive to mine gold every year. So if the price of gold doesn't go up, it's hard to maintain your earnings. And if the price of gold goes down in the face of rising costs, that's a double whammy. And so the investors were staying away from gold stocks because they were very suspicious of the rally. Well, looking at the action this week, and even in recent weeks, I'm starting to see investors gaining some confidence in this bull market, because I'm seeing days now where the price of gold is down quite a bit and these gold stocks are up. They used to get killed. I mean, every time gold went down, they got destroyed. And then gold would make a new high, but the stocks wouldn't make a new high because they got beat up so much on a small dip. But now, instead of being dragged up by the metal, gold stocks are starting to lead, with both the GDX and the GDXJ making 52-week highs on the week. In fact, the GDXJ, which made a new high after the GDX, made a new high this week and made a new high today on Friday. And both of those indexes are now up 65% on the year. That is a big move. Gold itself is only up about 25%. So finally, after years of lagging, they're now starting to outperform. And this is a bullish sign, because now we've got confidence in this bull market. Now, some people might say, well, isn't that a contrarian indicator now that people are buying these stocks? Not really, because this is sophisticated money. The public is not involved. And it's not like this is a mania, a blowout stage where you go to the supermarket and the cashiers are talking about the penny gold stock that they just bought. You know, the public is not involved in this market. This is more sophisticated money finally moving in. And the way I noticed that is a lot of these gold stocks, when they report their earnings, recently, every time they reported earnings, even if they beat numbers, they killed the stocks. And if they missed numbers, they destroyed the stocks. Well, a lot of companies have come out with earnings over the last couple of weeks. Some of them beat, some of them have missed, but even the misses were great earnings because, compared to what they earned the prior year. But what I've noticed is every time these stocks get sold off, almost reflexively on these earnings, they bounce right back. It might not be the same day, maybe the next day, next 2 days, but they recover everything and move higher. So you have big money now that is buying the dips in these stocks. And this is just the beginning of a huge wave. In fact, that's why, if you remember back in April, I kind of angered some of my reps, my precious metals specialists over at Schiff Gold, because I put out a special report from Europe Pacific Asset Management, and it was called The Best Way to Buy Gold. And I was saying, hey, don't buy gold right now. Buy gold stocks, because they were so cheap, and they're still cheap. Not as cheap as they were then, but still very cheap. I wasn't telling people not to buy gold. I was telling people to buy gold in the ground before it's dug up, because when you invest in a gold mining stock, you're buying the gold that's just still in the ground. When you go to Schiff Gold, you're buying the gold that's already been mined and fabricated and made into a nice, pretty coin or a bar, right? And you're buying that. And what I was saying with that report is, you know what? Gold's over $3,000 an ounce, and look how cheap these mining stocks are. You got to buy these mining stocks right now.
Huge news from China, Hong Kong drawing up plans to support gold trading. Special Administrative Region government is stepping up efforts to become an international gold trading hub and is reviewing related areas, including support for physical gold delivery, with plans to be unveiled later this year. As the city is making progress in building a commodity trading ecosystem, Chan underscored Hong Kong's advances in the non-ferrous metals market. Earlier this year, the SAR became a part of the London Metal Exchange's global warehouse network, an achievement he described as a significant milestone that has brought China closer to the world's most active metals trading markets. 8 LME-approved warehouses in Hong Kong have been operational since January, with more than 8,000 metric tons of exchange-registered warrants available to facilitate LME contract delivery as of early August, according to Chan. Beyond ensuring a stable regional metal supply, the move could also strengthen Hong Kong's shipping industry and support the growth of related services such as trade finance insurance and risk management hedging and derivatives. He added, the development in commodity trading is an example of Hong Kong's efforts to harness the opportunities arising from the technological revolution and a shifting global trading landscape to drive its economic transformation and upgrading in order to foster new growth engines, Chan said. So safe to say that BRICS master plan continues and the US dollar takes the L. Now, we'll show you the best clips of the latest interviews, but first, smash the subscribe button and turn on notifications so you do not miss out on our recaps. And check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trading the gold-silver ratio and increase your ounces. With this easy-to-read book, you'll know everything you need to know to stack efficiently so you don't have to rely on market commentators. Enjoy the episode.
That's with one statement, and it would take me 25 minutes of rambling. But in a nutshell, I believe he doesn't want to be the world reserve currency anymore. I really do believe that. I believe his actions are in an attempt to bring back as much manufacturing as possible before we flip the switch. Triffin's dilemma, Andrew, says, as being the world reserve currency, you will always have a trade imbalance. We cannot provide the world enough dollars alone through trade. And that, therefore, countries will need to sell their currency, which makes theirs weaker, to buy ours, which makes ours stronger in order to facilitate trade. Therefore, you always, as the reserve currency, hollow out manufacturing because it's far less to have it manufactured under that weaker situation than it is here. And that's exactly what has happened. Vice President Vance has come out and said, yeah, at this stage of the game, on White House letterhead citing Triffin's dilemma, that maybe it isn't such a privilege that one thought it would be, as being the world reserve currency. And it was for a very long time, Andrew. I mean, up until 1999, we had a trade surplus, not so much anymore, or a surplus in revenue. We are the largest debtor country in the world right now. So the problem is that for all of these years we've had, because we've expected the world to take our dollars and put reserves into treasuries, we've had low price goods at Walmart and Target, and we've had high asset prices and low interest rates. And so that's been the benefit, but at the expense of losing our manufacturing base. And we don't make anything anymore. And, you know, he is putting tariffs on all of these countries, including our allies. He's putting tariffs on pharmaceuticals, yet we don't make them. He's trying to bring as much back as he can. But how do you get to that point when we're 28 trillion, we owe 28 trillion in 3 years in maturing treasuries, with a 15 trillion in tax revenue over that time, not to mention the 3 trillion a year in deficit spending? That makes 2837 with 15 trillion tax base. So the inflation that must happen in order to pay this debt, I think, is something the world is seeing. This is along with the coercion. If you do this, and I'm going to put 100% tariff on you. This is what is pushing everyone towards the BRICS. Now, I can get to where I need to go on this and explain to you my thesis, but I really do believe that the world reserve currency at this point is not something that is in the best interest of a country where 60% of its population has no college education, and AI is going to kneecap much of the white-collar business. So where is everyone going to make a living? We need to put them back to work, and that would be through manufacturing. We need it for our own national security anyway. And how do you do that in an environment of inflation? How do you do that where it left for a reason. You bring it back under this environment and the cost of goods goes parabolic. The shelves become half empty. You get the Great Depression. And so that's where this all ultimately goes, in my opinion. And it's all related to backing of the treasuries with gold. And it's all related to the stablecoin bill. And I can, if you want, we can go down this path. I'm happy to. But okay, here's my thesis in a nutshell. You know, little by little, the name of my show, well, little by little, all of a sudden, stable coins are everywhere. Where the hell were they 2 years ago? No one knew stable coins. Trump was saying, Jamie Dimon was saying that crypto's a scam. And why would and now all of a sudden, bam, right in your face, little by little, and all at once, stable coins are everywhere. You're going to see corporations around the globe issuing stable coins. JP Morgan just announced a partnership with Coinbase, and they're going to allow the bank accounts to link with your crypto account, and you can trade your Chase points that you got for using your credit card into stable coins right through Coinbase, which will be linked one-to-one or real damn close to it to U.S. treasuries. The issuance of all of these stable coins and saying it's much easier and much quicker and blah, blah, blah. Okay, that's true. But I believe that Besant, who said we're going to go very big on stable coins, up to $2 trillion a year, will be used to load the front end of the yield curve. Up to 2-year duration in treasury, low rates, but the constant use of these stable coins will do just that. Now, what happens to the back end? The back end, to me, will be backed by gold. Now, Judy Shelton said to me on my show with her, and she's been saying it again lately, that July 4th next year, 2026, is a big day for Trump, a huge day, and it's the 250th anniversary of the country. And she said, Andy, he will issue gold-backed treasuries at that point, redeemable in gold. And I said, Judy, do you think gold will be revalued? It's held in the gold revaluation account. And not in so many words. She said, yes. Now, when we're done with this, I want to get your opinion on what you think about gold revaluation. But James Rickards comes up with a number of near 24,000. He does that by dividing the money supply into the gold. And well, if that happened, I'm just saying if it did, that would give the Treasury general account about $6 trillion free and clear, as every $4,000 increase would give the Treasury $1 trillion. Every $4,000 increase gives the Treasury $1 trillion free and clear. They would issue those certificates to the Fed, who would print the money out of thin air and give the money to the Treasury. Now, the certificates and the gold that they hold only gives credit or claim on the dollar value of the gold, not the gold itself. That belongs to the American people. So that it's an accounting.
Huge news from China, Hong Kong drawing up plans to support gold trading. Special Administrative Region government is stepping up efforts to become an international gold trading hub and is reviewing related areas, including support for physical gold delivery, with plans to be unveiled later this year. As the city is making progress in building a commodity trading ecosystem, Chan underscored Hong Kong's advances in the non-ferrous metals market. Earlier this year, the SAR became a part of the London Metal Exchange's global warehouse network, an achievement he described as a significant milestone that has brought China closer to the world's most active metals trading markets. 8 LME-approved warehouses in Hong Kong have been operational since January, with more than 8,000 metric tons of exchange-registered warrants available to facilitate LME contract delivery as of early August, according to Chan. Beyond ensuring a stable regional metal supply, the move could also strengthen Hong Kong's shipping industry and support the growth of related services such as trade finance insurance and risk management hedging and derivatives. He added, the development in commodity trading is an example of Hong Kong's efforts to harness the opportunities arising from the technological revolution and a shifting global trading landscape to drive its economic transformation and upgrading in order to foster new growth engines, Chan said. So safe to say that BRICS master plan continues and the US dollar takes the L. Now, we'll show you the best clips of the latest interviews, but first, smash the subscribe button and turn on notifications so you do not miss out on our recaps.
Up 4.5% in platinum and 4.5% in gold. And I'm looking to increase that, but not at this moment. listen, the bull market in gold is not exactly something that's a secret. It's outperformed the S&P 500 for the last 25 years. So it is a very long and protracted bull market. And the reason why I own 5% of it and not less, you have to have some. And I'm talking about liquid paper gold. I'm not talking about, I've always recommend you get 5% physical gold in your possession. You start there. And that's something that's an heirloom for your progeny. But if you want to talk about liquid paper gold, it's right now 5% because we have an insolvent nation with a currency that's weakening. And not only weakening against other flawed fiat currencies, but weakening against hard assets. I expect that to increase in a dramatic fashion next year. The only thing that gives me a little reticency about this is like if I said before, if the long end of the bond market really becomes intractable and rates begin to spike, it is going to hurt gold as well. Not as much as it's going to hurt Bitcoin, and not as much as it's going to hurt the S&P 500 and the major league tech. I mean, that's where the big bubble is in that Mag 7. That's where everybody is sequestered, and the Apple, the Google, the Amazon. And because they're market cap weighted index, you have passive funds just flowing into those stocks, and they become so. If the 490 stocks in the S&P 500 haven't grown their earnings at all in the last couple of years, it's just those 10 stocks, and those 10 stocks have the highest concentration of ownership ever in relations with the other 490. So you have a massive bubble that when the plug is pulled, there will be a very narrow exit door. So you have to identify it ahead of time and get out. And as I said, this is a Thursday evening recording. This is not the case right now. I'm not out of the market. But if you wanted to try and get, and I'm not gonna guess today and hold myself to it because I'm working every day. I don't have to hold myself to some kind of commitment to sell and set at the start of September. But an appropriate time frame, given the seasonality, and given what's happening in the next few inflation reports, according to my predictions, that inflation is going to run hot, both on PPI and CPI. And the fact that I believe the Fed is not going to cut rates by 50 basis points. You had Treasury Secretary Besson come on the other day and call for, and he did say it, I know he tried to walk the comments back today, but he wanted a 50 basis point rate cut immediately and 150 to 175 basis points in cuts in total. In a rather short duration. You'll wreck the dollar and you'll wreck the bond market, and I believe if you do that, it's all over for stocks, and you better be on the vanguard, monitoring those systems very closely, because you're gonna short circuit your retirement if you don't. My transactions are not anonymous; they're immutable and they're decentralized. None of those things are the case when you have the cryptocurrency tied to the U.S. dollar and to the U.S. Treasury complex. Everybody knows who you are. They know that you own it, and they're tied to the dollar, I thought these things were supposed to be rare and the protection against a falling dollar. So it's completely antithetical to every, supposed reason for these cryptocurrencies to have value in the first place. So that's my thought. I mean, if you're going to own a cryptocurrency, why would you tie it to the dollar and to a treasury bond? It doesn't. I think the demand for these assets is way overblown. It's going to underwhelm you significantly. I manage lots of money and I have lots of friends in the business. I don't know anybody's interested in this, really. It's a very arcane, small demand, and it's not going to give a lot of supply to treasuries. I don't think so at all.
What do you think of Pento's take? Do you agree with him? Is a mega meltdown inevitable in 2026? Will BRICS master plan destroy the dollar? Is this all bollocks? Post in the comments section down below your honest opinion and share with the stackers your plan. Are you buying more gold and silver regardless of higher prices? Now watch this video right here because it's a perfect fit for you, and I'll see you on the other side.